Good evening. Welcome to Ekcel Academy's YouTube channel. Hopefully, you are able to hear me and see the video as well. If at all there is an issue, please do let us know. Sometimes when I am streaming, I won't know the exact issue with audio or the video. Last time when we were solving FM question paper, we had some streaming issues. That's why we had to stop midway. So yeah, we'll continue from where we had left. I think question number 22 we had solved, and we also noted down specifically that none of the options given here are in fact the right answer. So the right answer is 69,072, and how to arrive at this also was discussed in the previous class itself. So sometimes institute does these type of things. In fact, even in June 2022 attempt, there are few questions for which there are no right answers, or when situations are in one of the questions, I don't remember the exact question number, where there were multiple right answers. So that is an issue with the institute even to this day. Anyway, moving on. Question number 23. Let's look at this theoretical question. Which of the following does not contribute to systematic risk? So first of all, we have to understand what exactly is systematic risk. Systematic risk is the risk that is inherent to the entire market or the whole market segment, as it affects the economy as a whole, and it cannot be diversified away. So that is the thing. For example, in case of a new competitor, the emergence of a new competitor will be a specific risk that perhaps only affects, let's say, a particular company or maybe that industry, and it can be diversified away in investing in variety of companies and industries. So that is in fact the a specific risk. So therefore, emergence of a new competitor, as mentioned here, is in fact not a systematic risk. I think this also we had solved or taken up in the last video. Okay, let's move on to the next practical question, question number 24. Let's see what exactly we have in store here. Varun Limited is issuing 1,12% irredeemable preference shares of the face value of ₹100 each. If the flotation cost is ₹2 per share, what is the cost of these preference shares? Okay, let's see. First of all, we have to write down the formula. Cost of preference share, which is KP, equals D by NP. So now D, we will consider it as the returns here. The returns, in this case, dividend obviously, and NP is nothing but the net proceeds from the preference shares. Now, if you read carefully, the preference shares have been issued. They have not mentioned anything. They have just mentioned that preference shares of the face value of ₹100. Since nothing is mentioned, we'll assume that it was issued at par, which is ₹100 face value. Okay, but there was some flotation cost involved in the issue of preference share, that is 2 per share. That means the company did not receive ₹100 per preference share which it issued, but instead it received 100 minus 2, that is 98 per preference share. So therefore, in this case, the cost of preference share would be 12%. So that is ₹12 on 100 face value. Always interest or dividend will be calculated on face value. Since face value is 100 here, 12% on 100 would be 12. Net proceeds, as I just now said, flotation cost should be deducted. So therefore, 100 minus 2, that would be the net proceeds. So when you do the math, you will get the answer. So let me just bring up the answer here. Okay. So 12 divided by 98, so which comes to 12.24%. 12.24%. So that would be the cost of the preference shares. Yeah, option C. I hope it is clear. Let's move on to the next one. If an investment of 3 lakhs pays 25,000 per annum in perpetuity forever, continuously basically, what is the net present value if the interest rate is 9%, they say? Okay, interest rate is 9%. Investment value is 3 lakh. And pays 25,000. What is the net present value? The interest rate is 9%. Okay, so now net present value of an investment is nothing but the difference between the present value of its future cash flows and the initial investment. Once again, net present value is nothing but the difference between the present value of future cash flows. Present value of future cash flows, maybe After 10 years, I will get 50,000. But that 50,000 is valued something else today. That 50,000 will be maybe valued less, because 50,000 of today will not be same as 50,000 of tomorrow. It will be far less, no? So therefore, we'll have to understand that. So that is the present value. And to calculate the net present value, all that we need to do is minus initial investment. So whatever we have invested earlier, if you remove that from the net present value, you will get the if you remove from the present value, you will get the net present value. So in this case, the initial investment is given, which is 3 lakhs, and future cash flows perpetually is 25,000 per annum, and interest rate is also given. So present value can be easily identified by doing this when using this formula. C, that is the annual cash inflow divided by the discounting rate, C by R basically. So how much is the annual cash inflow in this case? 25,000 divided by rate of interest. Rate of interest is 9%. You can even consider 9% or 0.09, one and the same. So when you do this, you will get the present value of this particular investment. So do this math. 25,000 divided by 0.09, which will give us how much? 2,77,778. Let me just round it off. So this is the present value of future investments. We will be getting 25,000, 25,000, 25,000, but the 25,000 is nothing but 2,77,778. That is the accumulation of all those future cash flows. In today's terms, what is the initial investment, or what is the value of this? This is 3 lakh. By investing 3 lakh, in future I am actually getting 2,77,778. Who would invest in such an investment opportunity? Why would I do that? If I'm losing money, I wouldn't invest, right? So what is the actual loss here? There is no benefit here. 277,778. So when you do that, you will get 22,222. Yeah, 22,222 is in fact the right answer. Of course, it is not profit, it is the loss. I invested 3 lakhs, but I ended up getting how much? Only 2,77,778. So I incurred a loss of 22,222. So which is the right option here? Option A. I hope it is clear. Let's move on to the next one. Which approach in capital structure argues that overall capitalization rate and the cost of debt remains constant? Overall capitalization rate and cost of debt remains constant for all degrees of leverage, as the same is offset by an increase in the equity capitalization rate. Okay, fine. See, the approach in capital structure that argues for a constant overall capitalization rate and the cost of debt for all degrees of leverage offset by increase in equity capitalization rate is none other than the net income approach. See, this approach suggests what, or tells us what? That the capital structure decision, such as the proportion of debt and equity used to finance a company, do not affect the overall cost of capital at all. However you may wish to raise capital, it will definitely not affect the overall cost of capital. Which approach tells us this? Net income approach. So now what is this? According to this approach, as a company increases its leverage, that is the debt to equity ratio, the cost of the debt remains constant, but the cost of the equity increases proportionally to offset the benefit gained from the tax deductibility of interest expense. Basically, what they're essentially saying is, by issuing debt, what will I what advantage will I enjoy? The advantage of paying the interest. How is interest payment an advantage? Because the moment I pay interest, the more and more interest I pay, the less and less tax I'll be required to pay. That is one advantage. But the approach is telling us, as much as you have that advantage, at the same time, what will happen is your expectation of the equity shareholders will increase, because the risk is more, no? If you issue more debt, there is more risk. Higher the risk, the expectation will also be higher. That means your cost of equity is increasing. That means to gain one thing, I'm actually losing one more here, something else. Okay, so therefore it won't really matter. So in fact, this approach suggests that the optimal capital structure is achieved by balancing the benefits of tax shield with the increasing cost of equity. So that is what they say, you have to balance it. To find the right balance of debt and equity, companies usually aim to maximize the value of the firm and minimize the cost of capital, while also considering the, let's say, the trade-offs between the tax benefit and financial risk. So that is easy. If you know these approaches, no, these type of questions are mere cakewalk. I won't consider this as a difficult question. Next, question number 27. An arrangement where a bank allows a borrower to overdraw up to a certain limit for working capital financing is known as, again very easy, bridge loan. This is not bridge loan. Term loan, definitely not. Leverage buyout, also not. Cash credit, basically your overall what is that, bank overdraft facility. So that is what is usually referred to as cash credit. Now, or you can consider this as a short term loan, because this is only for working capital thing. See, if you look at the other options here, what is bridge loan? It's a short term, it's also a short term loan, but it is used to bridge the gap between two long term financing arrangements. Let's say one arrangement is getting over, maybe I'm not getting any income from them or loan from there. Another arrangement will take another 3-4 months. I will get loan, long term loan, but after 3-4 months. Now to bridge the gap, I need some short term loan. So that loan is referred to as bridge loan. Okay. Then we have the term loan. It's a loan provided for a specific period, usually with a fixed repayment schedule. So that is also not there. Then we have leverage buyout, which refers to acquisition of a company using significant amount of debt to finance the purchase, like what happened in case of Twitter. No? Twitter was acquired by Elon Musk, but of course he did not have so much money. He had to get the money from somewhere else. Anyway, so now the simple answer in this case is cash credit. What is cash credit? It's an arrangement provided by a bank where the borrower is allowed to overdraw from their account up to a specified limit. Let's say some company has a balance of 10 crores here. Maybe the bank will allow them to overdraw to the extent of 12 crore. That is 2 crores in excess. So this is called the cash credit. So therefore options B is the right answer. Let's move on to the next one. Question number 28. Let's see what do we have in store. Funds represented by checks which have been issued but which have not been debited from the bank is technically referred to as. Funds represented by checks which have been issued. We have issued the check, but it has not been debited. If you have read bank reconciliation statement, you'll understand what exactly the situation is. And this is nothing but float. Now, what is this float? Checks that, I'm just reading out the definition. Represented by checks which have been issued, but it has not yet been debited by the bank. So it is the time period or the time gap between when a check is written and when a check is actually cleared by the bank. So during that time, during this intervening period, the funds will still be available. So this is called the float period. So funds are essentially in transit. No, we have issued the check, but whoever has received, maybe they have not yet deposited the check with their bank, or maybe the bank is taking undue time to honor the check, whatever. There will be some time gap. So until that check is actually honored by our bank, since we have issued the check, the funds will essentially be available in our bank account. So therefore that period is called float period, and that is nothing but float. Moving on. Okay, let me explain the other terms as well. What is indenture? Because those are, you may never know, you will get a question related to indenture. Indenture usually refers to a legal contract, or you can say agreement, often associated with debt securities. So that is indenture. Okay. Then we have forward contracts. It's nothing but a foreign exchange risk management strategy, just to protect ourselves against any future currency fluctuations. So that is forward cover. I'm not sorry, I said contract. Then we have proxy. Proxy has got nothing to do with this. Why did they mention proxy here? Proxy generally refers to any entity authorized to act on behalf of another party. So that is proxy. Moving on to question number 29, a practical question. Let's see. FM is generally easy, this compared to CMA. The net working capital of a firm is 14 lakhs. It purchased 30 lakhs worth of raw materials on credit. Issued 7% debentures for rupees 20 lakhs, non-current liability, and purchased a machine for rupees 18 lakhs for cash. The new net working capital of the firm will be how much? Okay. question number 29. Let's try to work it out. Net working capital right now is how much? They say 14 lakhs. Okay. So now it purchased 30 lakhs worth of raw material. So now on credit they say. So if it is 30 lakhs worth of raw material, on one hand my closing stock will increase, and on the other hand my liability will also increase. No, both are increasing. If both are increasing, will my net working capital change? Current liability is increasing, current liability is also current liability is increasing, current asset is also increasing. When that is the case, it will not change my net working capital. So purchase of raw materials on credit will not affect my working capital here. Then issued 7% debentures for rupees 20 lakhs will affect. When you look at it, you will think it's a non-current liability. How will it affect our working capital? It will affect because we are getting cash in return. No? You may issue debentures, but what will the debenture holders pay you? That is the company. They will obviously pay cash. Okay, unless of course it is consideration other than cash. But here they have nothing is mentioned. So therefore we'll assume that debentures for rupees 20 lakhs is issued for cash. So net working capital will increase by 20 lakhs here. Plus then and purchased a machine for rupees 18 lakhs for cash, they say. Okay, their cash is going out to the extent of 18 lakhs, so minus. That's all. 14 lakhs plus 2 lakhs, 16 lakhs would be the answer. That's it. Again, relatively easy. Not relatively, it's actually is easy. Let's move on to the next one. Question number 30. Let's see what exactly we have. A firm has a degree of operating leverage of 5 and degree of financial leverage of 4. Okay. The interest burden is 300 lakhs. Variable cost is a percentage to sales is 75%. Tax rate is 45%. Fixed cost is how much? Okay. Slightly indirect question. You'll have to work a bit to get the right answer. So these type of questions will invariably take time in the exam. Let's see how to solve this. Now a firm has got degree of operating leverage, okay, and financial leverage is also given. What is that they have asked? Fixed cost. How to identify fixed cost? We can think of contribution, sales, variable cost, fixed cost, profit. So when you think of that, you can think of fixed cost. But for that we need earnings before interest and taxes. Okay, let's think of it. Let me just write down. Imagine we have contribution. What is contribution? Sales minus variable cost, that you know already, minus fixed cost is nothing but profit, or in other words earnings before interest and taxes. Then of course if you remove from this interest, you will get earnings before taxes. Now what do we know here? We don't know anything, no? So interest burden is what is known. So interest I can write it as 300 here. Okay. Okay, let me do one thing. Let me write down the formula so that we will at least try to identify what is what. Okay, since financial leverage is given, financial leverage formula would be EBIT by EBIT minus interest. Earnings before interest and taxes divided by earnings before interest and taxes minus interest. Why we have written specifically here? I could have simply written EBT, but we have split it because we have interest portion here separately given, so I am using that. Financial leverage is how much? 4. EBIT we do not know, we'll call it as X. Denominator will be X minus interest of 300. So now solve for X. So this denominator will go to RHS and get multiplied by 4. So 4X minus it will become plus, no, actually 1200 equals X. So this will be 3X will be 1200, X will be 400. So what was X in our case? Earnings before interest and taxes. So now I can fill this gap, 400. So EBIT is 100. So EBIT is what which was required, no? So no, fixed cost is what they have asked. So now we have been able to find out the EBIT. Okay, so let us try to identify that also. See, as I said, the information is not available, so we have to indirectly proceed. So we are proceeding from somewhere, wherever the information is available, we are trying to make use of it and trying to arrive at the answer. Okay, it will take time, but that's okay. So now what else is given? Operating leverage is also given. So operating leverage is nothing but contribution by EBIT. Contribution by EBIT. So now operating leverage is how much? 5. Contribution we do not know, divided by EBIT is 400. So X will be 2000. So contribution is 2000. So therefore the balancing figure 1600 is fixed cost. Such a roundabout question. Obviously option A is the right answer. But if you know the concept, if you know the formula, this is definitely not a difficult question. It's easy, but maybe it will take 1 or 2 minutes. That's all. Anything more than that, it will be difficult to make up for the lost time later on. Okay. So these type of questions you should take 1 or 2 minutes. That's okay. Reasonable. Let's move on to the next one. Theory question. ABC analysis is useful for analyzing inventory based on their usage and movement. Yeah, that's the thing. No, option A is in fact the right answer. Anyway, let's look at the other options. Reduction of total investment in material, no. Determine the optimal level of safety stock, no. Analyzing inventory based on their availability, definitely not any of this. Obviously activity based ABC, this is not activity based costing anyway. ABC analysis is useful for what? Analyzing inventory based on their movement. So what we do is we grade them, A category, B category and C category. So A is the most important category and it is given the most attention. So B slightly less attention and C is the least important one. So that is how we split. So based on that, option A is the right answer. There is no doubt about it. Let's move on to the next question. Question number 32. Considering the following factors, gross operating cycle is 80 days, net operating cycle is 55 days, raw material holding period is 40 days, conversion period is 2 days, finished goods holding period is 20 days, average collection period will be, again, very easy problem. What is that they have asked? Average collection period. Let's try to answer this. See now, gross operating cycle, what is this? Again, you'll have to remember this. If you know this, then it's easy to answer. Otherwise, there's no way you can answer this. Gross operating cycle is nothing but the raw material holding period. So now what is the entire gross operating cycle? Okay, raw material holding period will come into picture. After that, once you hold, what is the next thing which you do? You will convert. No, so conversion period will come into picture. Okay, we have to convert raw material into finished goods. That's the thing. After conversion, it becomes finished goods. So for how long will you hold that finished goods? Finished goods holding period. So that will also come into picture. So then once you sell, the next thing is about collection. So finished goods, hold it, sell it. Then once you sell it, you need to get back the money from the debtors basically. So that would be the average collection period. Okay, so now what is what in this case? Raw material holding period, have they mentioned? Yeah, 40 days plus conversion period 2 days, finished goods holding period 20 days, and average collection period, where is it mentioned? Oh, that they have not mentioned. That is what we are supposed to calculate. Okay, so then that means X gross operating cycle would be how much? 80 days. So solve for X, you will get it. That's all. So now if I add all this 62, so 80 minus 62 will be X, which is nothing but 18 days. So option C is in fact the right answer. Easy question. Let's move to the next one. Question number 33. MNC expects its sales to increase by 10% from the current year level of 5 million. So 5 million is the sales right now. The company expects it to increase by 10%. With a net profit margin of 8% and a payout ratio of 30%. What financing for the next year will be available from the internal resources. That means retained earnings, basically how much of retained earnings will be there. So the sales was 5 million. So now they expect it to increase by 10%. So that means 5.5 million. So 5 million, 5 million plus 10%, no. So 50 lakhs plus 5 lakhs, 5.5 million, yeah, correct. So 5.5 million is the increase or the expected sales. Then what about the net margin? The net margin is 8%, they say 8% on this anyway, net profit margin. So 5.5 million, 550000 into 8%, which will be 4,40,000, 4,40,000 or 440,000. Then what else is given? Payout ratio is 30%. That means how much are we paying as dividend? So less dividend payout ratio, 30% on 440. So into 30%, which will be 1,32,000. So whatever is the difference, that will be the retained earnings. 132 minus 448, then 0, then 208. No, 4 minus 1, 3, 308. So this would be the retained earnings, option B. Nothing much here also. Very easy, straightforward problem. All these problems are actually not strictly related to FM. I mean, even though someone has not studied FM, if they know the basic math and if they have an understanding of what is what with respect to commerce, they can easily answer these type of questions. It's not very subject specific as such. Let's move on to the next one. Question number 34. If a company acquired a helicopter for its top management for a certain period on a fixed payment, which of the following will be true regarding leverage? Okay. So they acquired a helicopter for top management for a certain period on a fixed payment. So now degree of operating leverage will increase, degree of financial leverage will increase, degree of operating will decrease, degree of combined leverage will remain unchanged, they say. Okay, so now first of all, let us understand what is degree of operating leverage. It is a measure of how sensitive a company's earnings before interest and taxes are to changes in the sales. If the sales change, to what extent the earnings will also change. So that is the sensitivity. When a company acquires a helicopter, let's say for its top management for a certain period on fixed payment, it is essentially adding a fixed cost to its operations. That will be always there. Okay, so this will increase the company's degree of operating leverage, because even a small change in the sales will now have a larger impact on the EBIT. For example, let me give you an example. Let's say a company has a degree of operating leverage of 2. What does that mean? That means if there is any change in the sales to the extent of 10%, the change in EBIT will be 20% because of the degree of operating leverage of 2, twice. So if the company acquires a helicopter to its top management by paying some, let's say 1 lakh rent, this will increase the company's fixed cost by this much, because it will always be payable. So now as a result, the company's degree of operating leverage will increase, obviously. That means what? Change in something will now result in change in EBIT also. Higher percentage of EBIT will get affected. Okay, so that means increase in degree of operating leverage can be a good thing and also can be a bad thing, depending on the company's situation. If the company is in a growing market, then increasing degree of operating leverage can actually help it to increase its profit more quickly. The responsiveness will be higher. But if it's in a declining market, then if there is any increase in degree of operating leverage, the company will obviously end up incurring losses, because EBIT will decrease exponentially. So that is something which you have to remember. Again, these type of questions completely relies on your conceptual clarity. They are basically testing that, like how clear are you with respect to your concepts. So therefore, in this case, option A would be the right answer. I hope it is clear. Let's move on to the next one. Did I skip something? Suddenly, 33, 34, 35. Which of the following is not a valid Assumption of approach to capital structure. Okay, let's see. Securities are infinitely divisible, lack of free flow of information, transaction costs are zero, no taxation. Okay, this again, it depends on how much you have understood approach, Modigliani-Miller approach. Based on that, you can easily identify the right answer. See, their theory states that the value of a firm is independent to its capital structure. That means capital structure has got nothing to do with the valuation of the firm. So, but they have few assumptions. What? Securities are infinitely divisible. That means investors can buy and sell any amount of securities they want. Transaction costs are zero. No taxation. Perfect information. So that is their assumption. Okay. So now based on that, which assumption here is out of place? There is one assumption here which is definitely not Modigliani-Miller approach assumption, which is lack of free flow of information. There you will get perfect information. Lack of free flow of information is definitely not an assumption. It's the reverse of approach assumptions. Okay. So option B is the right answer there. Which of the following will not have an impact on the firm's treasury position? That means cash. Which activity here will not affect our cash flow at all? Okay, how much our cash we have, the same thing we will have even after this activity. Which one? Dividend payment. Dividend payment obviously involves cash flow. No, we will have to make the payment of dividend to the shareholders. So it will definitely affect our treasury position. Tax payment also affects our treasury position because we are essentially paying tax. So that means the cash flow will come down. Buying fixed assets will also involve some amount of cash, but issuing bonus shares will definitely not affect our cash flow because it has got nothing to do with cash. We'll use the reserves and issue bonus shares. No cash inflow, no cash outflow. So therefore, the firm's treasury portion will not have any impact with respect to issuing the bonus shares. Let's move on to the next one. Question number 37. A firm has a degree of operating leverage of 6 at a certain production level. If the sales of the firm increase by 1%, what is the implication? So if DOL is 6, that means even if sales increase by 1%, your EBIT will also increase by 6%. So that is the impact here. As we just now discussed in one of the earlier questions, in a growing market, this is actually fine because anyway, my DOL is increasing, my sales is also increasing. That means even if my sales increases by 10%, if my DOL is, let's say 30 is too much, 3, then my EBIT will also increase by 3. That means, there is too much of sound here. Just a second. Let me just close the window. So if DOL increases, if DOL is 3 and if sales increases by 10, my EBIT will increase by 30. So that is the implication. So therefore, based on that, option C is in fact the right answer here. Question number 37. Then question number 38. Let's see. Determination of safety stock requires a trade-off between carrying costs and stock out cost. This is in fact the right answer. The first option itself is the right one. See, safety stock means we will have to have some amount of stock with us. But the problem with that is we will always be carrying something. No? Just because we need to be safe, that means we should not get exhaust the stock. We will obviously carry something. So safety stock is nothing but the amount of inventory that a company keeps on hand to protect against unexpected demand or supply. So the determination of safety stock requires obviously a trade-off between carrying costs and stock out cost, that is buying cost. So carrying costs are associated with the holding inventory, such as storage cost, insurance cost, maybe the cost of capital, because we will have to pay the amount. So the optimal level of safety stock is that level which minimizes the total carrying cost and the stock out costs. So this will obviously that's the obvious answer. This was easy actually. Question number 38. Question number 39. Let's see. So many theory questions. So even though it says FM, it's a practical paper, but you can only see theory questions here. Which of the following is not a valid assumption of economic order quantity model? Okay. Demand forecast is available, inventory can be replenished immediately, cost per order is variable. Cost per order cannot be variable in EOQ model because cost or buying cost or cost per order is always same. So that is obviously not a valid assumption. Carrying cost is a fixed percentage, so that is also fine because it will always be same. So option C is in fact the right answer. Next, which of the following investment decisions is required to be taken for a stock if its intrinsic value is greater than its market value, they say. Okay, let's see. Intrinsic value. A stock's intrinsic value is greater than its market value. If that is the case, then it is considered to be undervalued, no? Intrinsic value is greater but the market value is less. That means the stock is obviously undervalued. So the trading price is lower than its true value. Maybe it is getting traded at 100 but its actual true value is maybe at 130, 140. So in this case, what to do? It may be a good investment to actually buy this stock because undervalued stock, go buy it. Okay, but there is no guarantee that the stock will rise in value just because it is undervalued. There are many such undervalued stocks even in the market now. But does that mean that the stock will actually increase immediately? It may not happen now. It may not happen after 1 year also. Eventually it will happen. Okay, because market forces anyway. So the correct answer here would be to buy undervalued stock. So therefore buy it. Next. Question number 41. Finally, there is some practical question here. Monthly demand for a raw material is 150 units. Ordering cost, they should have just mentioned that per order we know already, is 8 and annual carrying cost is 2. Economic order quantity under the above circumstances will be. See, EOQ is nothing but root of 2AB by C. Okay. So now let us try to plug the values. Annual consumption, buying cost and carrying cost. A is annual consumption, B is buying cost, C is carrying cost. 2 into how much is the consumption here? 150 units monthly. Monthly 150 into 12. 15 tens are 150 plus 30, 180. So that means 1800 units. No, into buying cost is how much? 8 rupees divided by carrying cost is how much? 2 rupees. When you do the math, you will get it. So 3600 into 8. 3600 into 8 divided by 2. 14400 root of it. So that will be 120. So 120 is in fact the right answer. I hope it is clear. Let's move to the next one. Earnings per share. Okay, what is earnings per share? This we know. Earnings per share is nothing but it's a financial ratio basically that measures the company's profitability per one equity share, like how much an equity shareholder is earning for one share. How to arrive at that? It is divided by calculating the profit available to equity shareholders divided by number of equity shareholders. So going by that formula, which one of these options makes sense? Okay, let's look at it first. Profit after tax divided by number of shares in authorized capital. Profit after tax divided by number of shares in issued capital. So obviously option B is in fact the right answer. So authorized capital, no, because we need to know the you should consider the issued capital, not the authorized capital. Then question number 43. Interest coverage ratio of 6 indicates what? Sales are 6 times of interest. Profit after tax is 6 times of interest. EBIT is 6 times of interest. EBIT is 6 times of interest. See, interest coverage ratio again is a financial metric that measures company's ability to pay its debt obligations, like how well equipped a company is right now to pay off its debt. It is calculated by dividing the company's earnings, of course before interest and taxes, by its interest expense. So if it is higher, that means what? Company has more and more ability to pay off its debt obligations. But if it is lower, that means company doesn't have too much of ability. Maybe it is barely able to cover its debt. So option C is in fact the right answer. Okay, we'll stop here. There's some construction activity going on. Unfortunately, we had to stop. But anyway, we have covered enough. In the next live session, we'll be able to cover the rest and then move on to the next paper. Thank you for attending this. Okay, see you maybe tomorrow, I guess. Thank you guys. Bye bye.